and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. With the clamour for stimulus to boost the economy rising to fever pitch over the past few weeks, the pressure on the Monetary Policy Committee and the RBI to do its bit has also been rising. Will the MPC and the RBI succumb to the pressure? Let's see what Dr. Barendra Kumar Boy, former Principal Advisor to the Monetary Policy Division RBI, and S. Vishwanathan, former Managing Director, State Bank of India, have to say about this. Welcome to the show, Dr. Boy and Vishwanathan. Let me start by asking each of you in turn, what is your take on the macro economy? Assuming that there is a relationship, if not a trade-off between growth and inflation, and I say that because the nature of the relationship is something that economists never really agree upon, should the MPC put growth concerns to the front burner? Let me turn to you first, Dr. Boy.
The economy is passing through a critical phase of transformation. There are a large number of repeated shocks, starting with demonetization in November 8, 2016, then GST, Goods and Services Tax, starting from July 1, 2017, then other structural reforms like RERA, IBC, Insolvency and Banking Bankruptcy Code. In addition, there is also asset quality review pursued by the Reserve Bank of India. Then prompt corrective action has been taken against some banks. Basel III capital requirement is being implemented. In addition to that, there are also global shocks like normalization of monetary policy, uncertainty relating to Brexit, and other uncertainty relating to this oil production, etc. So economy is facing simultaneously domestic and also international shocks. In such a situation, economy requires some time to adjust, and these reforms that have been pursued, these are transformational and very much necessary. In view of this, there is a need to support the growth for some time, so that we can get or we can reap the maximum benefit of the structural transformation that is taking place in the economy. So far as inflation.
Okay, Vishwanathan, would you agree with? Okay, I'll come to that a little later, Dr. Boy, but let me just ask Vishwanathan whether he agrees with your assessment that the economy is passing through a critical phase due to a variety of shocks. So, Vishwanathan, would you agree with that fully, partially, and why?
I agree with Dr. Boy in the sense that India has had a number of shocks, be it demonetization, be it GST, and a whole lot of others like RERA introduction. All these things are doing business differently from before, and many of them have resulted in cash flow related issues for the various entities, and that in turn has resulted in bottlenecks in the whole system, resulting further in drops in GDP and drop in productivity, etc. So I do agree that a number of things that have happened in the last 6 months, 1 year, have had an impact in the way the economy is positioned today.
Dr. Boy, since you're the monetary policy expert, let me ask you about monetary policy. In one of your recent pieces in one of the business papers, you touched upon what to my mind is the crux of the problem, that our monetary policy stance is not in sync with the liquidity conditions, and that is bound to affect monetary transmission, because when banks are not borrowing from the Reserve Bank of India, they do not benefit from any repo rate cut. The impact of the recent repo rate cuts remains muted at the first stage of transmission itself, and expecting banks to transmit the signal further is futile.
Yes, there is a disconnect between the stance of monetary policy and liquidity condition. Neutral monetary policy stance requires the liquidity condition should be neutral, in the neutral position, but because of this demonetization, there is surfeit of liquidity in the banking system. This is gradually being adjusted, but nevertheless the deposit growth continues to exceed this sluggish credit pickup by a wide margin. This appears to be somewhat enduring in nature. In view of this surfeit of liquidity, it may so happen that the commercial banks are putting money back to RBI rather than borrowing from the RBI. The transmission is in the first stage itself it is distorted. So in view of this, they are not getting the benefit of cut in the repo rate. The recent repo rate cut was rather this impact was rather muted, commercial banks are also passing through a critical phase of handling piling up of large amount of NPAs. So, in view of this, the transmission is also distorted. This is a global phenomenon. When monetary condition is loose and financial condition is tight, there is a conflict between this monetary policy and the financial sector policy, and transmission is distorted. And in view of this, possibly commercial banks are not in a position to pass on this benefit to the borrower.
That is true. In fact, poor monetary transmission is an issue all over the world. But Vishwanathan, banks in India are always accused of not passing on the rate cut by the Reserve Bank of India. But my question here is that given that the RBI supplies only a very limited quantity of funds at the repo rate, and ultimately the lending rate will have to take into account the cost of funds, which in the Indian context, unlike abroad, is essentially the cost of deposit, why does anyone expect a one-to-one relationship at all between the RBI repo rate and the bank's lending rate? Bank's lending rate will be primarily determined by the cost of deposits. Vishwanathan?
Yeah, you're absolutely correct. In India, unlike in the United States, for example, the banks survive on deposits and not on borrowings from the interbank market or the repo market. So really speaking, that market is not even very so well developed as to take care of the requirements of the bank on the whole. And the banks think it is better for them to go and get the deposits from the market, and that's also cheaper for them, and it also gives them a lot more leeway in terms of pricing their loans. That is one part. Now, the real issue is today, even if Reserve Bank were to reduce interest rates, assume for a moment as Reserve Bank were to reduce the repo rate, will the banks be in a position to pass it on, or is the scenario such that can Reserve Bank, is it conducive, or is the situation such that Reserve Bank will reduce the repo rate? That is one part. The second part is, even if it reduces, will it reach the final borrower? Third part is, does the borrower does he think that he can do better by having a reduced interest rate? So all these three things are to be seen together. Now let's take the middle point only, which is, are the banks able to pass it on or not pass it on? The banks in the new MPLR scenario are kind of pushed into transmitting rates better than they were doing it earlier. Whether it's right or not, that's a separate debate. But having said this, the transmission process today is slightly better than it was before, at least in terms of the rate transmission. Now, but today you just see one thing. During the demonetization process, the bank deposits grew enormously. But if you see the deposit growth from April to July, there is a fall of 10,000 crores. But the funny part is, the loans have come down by 70,000 crores. So the credit deposit ratio, though it seems like 700%, it is both on negatives. On the numerator, it is a minus 70,000 crores, and the denominator is minus 10,000 crores. So we are in a completely new scenario where deposits are falling and the loans are falling. And can we reduce the deposit rates further at the banking level? I really don't know, because there is let's say a 4.5% expected inflation, and the repo rate is already 6%. So where do we go from here?
Okay. So even assuming that there are problems with monetary transmission, Dr. Boy, the fact is that if the MPC does veer towards growth, the logical policy action would be to reduce interest rates. But given the long lags in monetary policy and the fact that the RBI seems to have been behind the curve, can and should the RBI make up for lost time and go in for a very aggressive cut, say 50 basis points? Or should it continue with what an earlier Governor Subbarao used to call baby steps? Because we do see inflation also inching up. Dr. Boy?
In case of transmission, I can say you that in case of India, transmission is much better compared to many parts of the world. Transmission is taking place. After this demonetization, commercial banks have reduced lending rate considerably, which they were otherwise not passing on to the borrowers. Once there was a reduction in the deposit rate, and also there was a pending transmission from monetary policy to the borrower. So taken together, they have passed on quite a bit of cut in the repo rate earlier. So transmission in India is taking place compared to entire disruption in western part of the world. So that one has to understand, transmission cannot take place on a one-to-one basis. Always there is long and variable lags in the monetary policy transmission.
No, so my question really was that since transmission is not one-to-one, should you go in for a 50 basis point cut in order to have a 25 basis point transmission? Dr. Boy?
Actually, nominal policy rate, if you will see, it is, suppose there is no output gap, there is no inflation gap in the economy, the nominal policy rate should be real interest rate and expected inflation. The real interest rate, equilibrium real interest rate in the economy would be around 1.5. So 1.5 and expected inflation is around 4, 4 plus 1.5, so it becomes 5.5. Or if expected inflation is more than 4, it becomes 4.5 plus 1.5. So it means the space is limited. So in view of this, one has to see if there is an output gap which is negative, probably there is a space, because this coefficient of output gap is negative. This will reduce this nominal policy rate, and inflation is under control. Probably space limited, space available is limited, and if there is a space, this available limited space is available. So another 25 basis point cut is probably possible. But at what point of time, that the RBI and MPC will take a call, right away in October or in December.
Okay, so it all depends on the kind of assumptions we make about expected inflation, about output gap, and as always, everything is up in the air.
Yeah.
But on that note, it's time for us to slip into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and I'm in discussion with Dr. Boy and Vishwanathan on what should we expect from the MPC, what can it do and what should it do. Vishwanathan, before the break, Dr. Boy was talking about the space for an interest rate cut. But my question to you is, will a rate cut result in an increased offtake of credit from banks? Is it a problem of supply with banks unwilling to lend, thanks partially to the witch hunt that we've seen of bankers? Or is it a demand problem with corporates unwilling to borrow, in which case a reduction in rates will not make any difference at all? Vishwanathan?
Well, as I said earlier also, in my opinion, the issues have more to do with debottlenecking at various levels rather than reducing interest rates. So the reduction in interest rates, it has its own dynamics of whether it's in line with the economy, etc., etc. Those things will go into the minds of Reserve Bank of India monetary policy makers. But assuming that, as Dr. Boy said, you have a scope for reducing it by 0.5%. Or 1% as many people want, or 0.25% as other people might expect Reserve Bank might do. Taking any of these, is it going to make a difference in terms of credit offtake? I really don't know. Of course, it will be a feel-good factor. There could be offtake in a number of areas where projects are stalled, and this might be a palliative for those people who are paying interest rates when nothing is working. So definitely a reduced interest rate will help, and that might kind of lift up the sentiment. Absolutely correct. But is it going to bring in new projects, or is it going to start projects which are on the anvil? Will foundation stones be laid? I really don't know, because those are not the reasons why credit offtake is not taking place. And also, in regard to, assume you reduce interest rates, and even those stalled project, the guys who are running the show, they feel good. But can it matter in terms of the projects starting again and taking them forward? Will this reduced interest rate help? Not really, because I think we need to do a lot of things at the ground which would help these projects to come back to life, particularly the infra projects.
Dr. Boy, if I can shift to something slightly different. Post the shift to inflation targeting, the MPC is charged only really with inflation control, that is with maintaining the internal value of the rupee. Ideally, the internal and the external value of the currency should be broadly in sync. But in a scenario where the exchange rate, which really reflects the external value of the rupee, is moving up in response to strong forex inflows, which are completely unrelated to the underlying fundamentals, does this not result in some kind of a disconnect between the internal and the external value of the rupee? Or is the RBI willing to live with that, since an appreciating currency also keeps inflation down? Dr. Boy?
Yes, internal value of money is determined by the inflation, external value, exchange rate. Both are factored in the model. The RBI model takes into account this output gap and also the possibility of exchange rate creating problem in the system. The whole issue is, if fundamentals are strong, then if there is a flight to safety, the economy can escape with least injury. There can be some sudden outflow of capital for a brief period, but given the fundamentals, it will continue to attract a lot of inflow of capital. Given our low level of current account deficit, external current account deficit, the foreign direct investment is sufficient to finance the external current account deficit. That is where actually the problem lies, that we need not maintain a high interest rate differential to attract capital for investment in the debt segment. In view of this inflow of capital, which is mostly governed by fundamentals of the economy in a medium term, one has to be careful that if we are maintaining high rate of interest rate differential, speculative flow will be more. There lies that we can be able to handle this liquidity problem as well as the bubble building up in the asset prices by keeping the interest rate differential at a level that is sufficient to finance this external sector deficit.
Yes, so clearly, in fact, we need to keep an eye both on the internal value and on the external value. But Vishwanathan, there is a equally important, yes. But Vishwanathan, there is a sense that in the RBI's quarterly statements, bi-monthly statements rather, these are excessively focused on interest rate and developments in the banking space don't really get the attention that they deserve. I say this particularly because the RBI's past policy statements have been quite silent on the developments after the bankruptcy code came into operation, such as what has happened in the case of Synergy, Dore, where banks had to take a 94% haircut, and finally a related party bought the company really for a song. But the RBI's policy statements don't seem to be bothered about this, or if they are, they don't express it. Would you agree with that view, Vishwanathan?
Well, Reserve Bank is definitely an entity which is concerned, is related to these kinds of events. But this is more to do with something which is outside Reserve Bank of India. So I really, except for facilitating things towards, bad debt resolution, etc., I really don't know whether they can do something directly. But coming to this NCLT related issues, now this is in the initial stages. Not even one item has been resolved completely, or it's gone through the full cycle as yet, and people are still in the learning mode. There are lots of issues which require resolution, as evidenced by the fact that Supreme Court has been hearing issues under this expeditiously and giving their directions. And there are a number of issues that have come up in this which are in the nature of straightening up the system or filling the gaps, as I would see them. So really speaking, things are moving forward in that area, and Reserve Bank under the ordinance is pushing banks to make use of this facility, and in that sense it is aiding, and it is also giving directions in terms of the kinds of provisions that are required, etc. Right or wrong, we can debate them, but all this is still work in process. I really don't think final stability has been achieved in regard to the whole process.
Yes, I agree it is work in process, but I also think that the RBI should have taken a slightly more nuanced approach in terms of the kind of aggressive provisioning, the AQR. It was a bit too much of a shock treatment. So that is where I would like to kind of fault the Reserve Bank of India in the way that it's kind of followed a textbook rather than a practical approach. But Dr. Boy, if I can stick with monetary policy with you, how much does a monetary policy really impact prices in a scenario where the large part of the consumption basket food and fuel is largely outside the purview of monetary policy? And also, why is it that the Reserve Bank of India's inflation models have gone wrong repeatedly time and again?
Yes, supply shock may distort the prices for an agricultural season. Season may be 3 to 6 months, or if it is annual crop like sugarcane, it may be 1 year. But the supply shock may be generalized into generalized inflation if your money supply is more and monetary policy is accommodative. I would like to give the example. In 2013-14, we had a high level of agricultural production, and agricultural prices were very high. At that time, there was a generalized inflation because accommodative monetary policy has aggravated the situation. Fiscal policy was also out of the FRBM discipline. Then 14-15, 15-16, 2 drought years, but the food prices came down through supply management. So we have now 2 consecutive years of good monsoon. Supply is a threat to inflation. The upside risk to inflation coming from food is less because of good harvest, and government continue to manage the supply side effectively, so that if there is a hiccup in the prices of some commodity, they are trying to manage through supply management. So supply management in India has improved significantly, and therefore given the high level of agricultural production, there is upside risk to inflation from food front is much less now. There was a temporary hike during last 2 months. This may not be sustained, mainly because this agricultural production will be coming to the market from next month onwards. In view of this, threat to inflation from food side is much less.
The whole purpose of the 1991 reforms really was to move away from mandated lending, pricing, etc., to a system where prices and interest rate is actually only the price of money. These are market determined, and competition ensures that nobody is taken for a ride. So you spoke about MCLR, etc., and RBI telling banks how they should price their loans. Why is the RBI interfering? Why not leave it to the market? We've done away with all those Bureau of Industrial Costs and Prices. So what is the RBI doing? Is it wanting to ensure that its transmission happens not through market forces but by diktat? Vishwanathan?
Yeah. I agree with you that the level of direction that has come in this regard is a little more than what many banks might have liked at that point in time. But I just talked to I keep talking to banks. They seem to have kind of reconciled themselves to this, and they seem to be moving forward. But just to say a couple of things in terms of a critique for this whole thing. The fact that the Reserve Bank wants the loans to be priced at current rates rather than at some average of historical rates is a valid proposition that they are putting across. But the way they have nudged the banks to calculate those numbers seems doesn't seem quite right to me. For example, they seem to be taking the weightages of your overall deposits which have been acquired at whole lot of interest rates over a period of time, but marking them to market at today's rates on that on the basis of the weights that you have in your portfolio of deposits, and then determining an MPLR and then giving a some kind of a slope to the existing slope curve, existing slope of the yield curve to this, and then creating various maturity MPLRs. So this is the way the MPLR thing is being worked out. But there are a couple of points I want to make in this. For example, many banks have got a lot of CASA deposits. Those CASA deposits comes through a lot of effort. So the banks would possibly want to keep some of that with them for the rainy day, or for using them in the way they would like that amount to be used. But Reserve Bank has said no, all that has to be brought in and it has to be passed on to the borrower. And it's some kind of a forcible passing on to the borrower, which many banks might like to do it differently. Not that they won't do it if competition sets in, but this seems to be done forcibly. The second point which I'd like to bring across in this, if RBI were to nudge people to get into this kind of a current interest rate kind of scenario, it would be much better for RBI to nudge and get a yield curve for trading purposes, for banks to trade the interest rates and of various maturities, and actually rebalance their interest rate portfolio inside the system in the real world through the trading process. That might actually bring in more transparency and the real economy into the interest rate process much better.
Absolutely. Apart from which, if as long as your deposits are on fixed rate and lending is on floating, there is an inherent mismatch in the two. But very quickly, Dr. Boy, if you want to respond.
The idea is that the legacy problem should not fall on the prospective borrower, because there is NPA and the average cost they are not in a position to recover. That's why they are loading it onto the new borrower. There lies the question of risk averseness by the commercial bank. If they are going to penalize the prospective borrower, then probably they are losing business. That is the reason why MCLR.
Well, they should be worried, but Dr. Boy, the bank should be worried about losing business. Why are you as a regulator, sorry, no longer you but your former employer, why are they bothered about losing business? It's the bank's lookout, but I'm afraid we run out of time completely. So even as this discussion on MCLR, in fact, maybe we need to have a full session on MCLR because there's so much to discuss, but we run out of time completely. So we'll have to end this discussion now. Thank you so much, Dr. Boy, as well as Vishwanathan joining me in the discussion. Clearly the RBI and the MPC are on a tough wicket and there are no easy ways out of the impasse. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now. In the meanwhile, if there's any issue you'd like to see discussed in this forum, please do write into us at the email ID you see at the bottom of your screen.